For a long time, people didn't treat Rolex like a watch brand. They treated it like a savings account with a dial. Buy one, put it in a safe, wait a year, sell it for more than you paid. Repeat. That belief became so widespread that millions of buyers stopped asking whether they even liked the watch. The only question that mattered was, how much will it be worth next year? That era is now over. Not slowly, not gently. It ended the way most financial fantasies end, when reality shows up with a bill. What just happened to Rolex isn't a brand failure. It's the collapse of a financial behavior pattern that only existed because money was cheap, risk was ignored, and everyone believed prices only move in one direction. And the data now proves it. By the end of this video, you'll understand why the flip-for-profit model is dead, why most Rolex references are no longer assets at all, and why only a microscopic slice of the catalog still behaves like a speculative vehicle. Let's start with the uncomfortable truth. Rolex never became an investment brand because of craftsmanship. It became one because of timing. From 2010 through the mid-2000s, prices rose gradually. That was normal collector growth. Then, the world changed. Between 2020 and early 2022, global interest rates collapsed towards zero. Trillions in stimulus flooded into markets. Crypto exploded. Stock accounts doubled. Suddenly, people were sitting on cash they didn't know how to deploy. That's when watches were rebranded as financial tools. Not by Rolex, by speculators. Steel sports models became portable wealth tokens. They were easy to resell, globally recognizable, and perceived as scarce. Online forums, YouTube channels, and social feeds turned specific references into buy lists. And the price response was violent. In less than 2 years, average resale prices for Rolex jumped nearly 93%. Not over a decade, not over 5 years, over about 20 months. That kind of move doesn't happen in collector markets. It only happens when speculative money overwhelms organic demand. At the peak, the distortions were absurd. A GMT Master 2 with a retail price near $11,000 traded above $35,000. A Submariner Date with a retail price under $10,000 sold near $18,500. A steel Daytona crossed $50,000. At that moment, MSRP stopped meaning anything. The reseller price became the real price. Authorized dealers became irrelevant middlemen in their own product ecosystem. But here's what almost nobody wanted to admit at the time. Those prices only worked because nobody was paying with real money. They were paying with borrowed money. Gray dealers financed inventory. Flippers used credit lines. Buyers justified debt because it'll be worth more next year. The entire structure depended on two things staying true forever: low interest rates and permanently rising resale prices. Then both collapsed. Central banks raised rates aggressively. Financing costs jumped to 8, 9, 10% annually. Suddenly, holding unsold inventory wasn't neutral anymore. It was a cash-bleeding liability. At the same time, speculative buyers vanished. Crypto collapsed. Tech stocks sold off. Disposable capital dried up. Demand evaporated. That's when the liquidation started. From the 2022 peak to mid-2025, average Rolex resale prices dropped roughly 31% before stabilizing. That wasn't a normal correction. That was forced selling. Dealers who assumed prices would rebound were trapped. Inventory sat. Interest accrued. Cash got locked. The only exit was to cut prices and take losses. This single event exposed the core truth. The 2020 to 2022 Rolex boom was not driven by watch lovers. It was driven by leverage. When leverage died, the market died with it. But here's where the story gets more brutal. The collapse didn't hit everything evenly. It split the market into two completely different worlds. World 1, the myth survivors. A tiny cluster of ultra-scarce steel sports models still behaves like an asset class. The steel Daytona still trades near $37,000 against a retail price around $16,000. The Pepsi GMT stabilized around $23,000 after falling more than 12,000 from its peak. Even the Submariner date still trades near 13,500 against retail under 10,000. These watches still carry massive premiums. But don't confuse that with safety. Anyone who bought these near the top is still sitting on devastating losses. A Pepsi buyer lost over 30%. A Submariner buyer lost over 25%. A Daytona buyer lost tens of thousands. These are not stable assets. They're volatile trophies. World 2. Everything else. And this is the part nobody wants to talk about. Almost the entire Rolex catalog, roughly 97% of it, is now behaving like a normal luxury product. It depreciates. Milgauss models are now commonly available below retail. Two-tone sports models are now money-losing inventory. Several references trade below dealer acquisition cost. The idea that Rolex always goes up has now been mathematically destroyed. Only a microscopic slice of the catalog ever functioned as a speculative asset. The rest were just temporarily inflated consumer goods. Rolex saw this happening in real time, and they didn't sit still. They moved fast to regain control. First, they restructured retail pricing. Instead of aggressively raising steel sports watches, they hammered precious metal models with increases up to 14%. That wasn't about gold costs, it was about perception. By lifting gold prices, Rolex raised the entire price floor of the brand. That narrowed the visual gap between steel MSRP and gray market pricing, reinforcing the illusion of value stability. Then came the real weapon. Certified pre-owned. With CPO, Rolex created an official resale channel that anchors prices artificially high. Certified watches now sell 15 to 40% above equivalent gray listings. A certified Submariner can sell thousands higher than the same unworn piece outside the program. This does three things at once. It protects the value narrative. It drains profit from unauthorized dealers. And it redirects speculative margin back into Rolex's own ecosystem. Rolex is no longer letting outsiders set resale reality. They are doing it themselves. So where are we now? Not in a crash, in a reset. By mid-2025, declines slowed sharply. Prices stabilized. Quarterly movement flattened. Panic selling ended. The speculative layer is gone. What remains is real demand from people who actually want to wear the watches. At the same time, culture is shifting. Younger buyers are moving away from steel sports dominance. Design-driven watches are winning. Slim profiles, vintage aesthetics, quiet luxury. This is why Cartier and Omega are quietly winning right now. Cartier Santos values have doubled over 5 years. Omega continues steady growth without hype spikes. Desirability is moving away from artificial scarcity toward aesthetics and heritage. So what does all this actually mean? For flippers, it's over. The arbitrage model is dead. Cheap credit is gone. CPO killed margins. Holding inventory is dangerous. And only a tiny number of references still offer speculative upside, with enormous risk. For collectors, this is the best buying environment in years. Prices are rational. Supply exists. FOMO is gone. And purchases can finally be driven by taste instead of panic. Long-term, Rolex still has strength. Over 15 years, average appreciation exceeded 500%. But that was history, not a promise. So here's the real decision now. With normalized models trading near retail and hype pieces still holding massive premiums, what makes sense? Would you buy a stable reference you can actually enjoy? Or chase a Pepsi or Daytona at MSRP and gamble on volatility for profit? That's the new Rolex reality. Let me know in the comments.